everyone, it's Matt Weaver, and thank you for joining me for your morning shot. On Wednesday, Federal Reserve Chairwoman Janet Yellen announced they would raise the federal funds interest rate by a quarter point. This is the fourth increase since December of 2015. For those a little unsure as to what the federal funds rate is or why it would matter to us in real estate, note that the federal funds rate is viewed as the base rate for determining the level of all other interest rates in the U.S. economy. But it is not the only rate that governs the entire economy. Case in point, with the rise in federal funds rate, mortgage rates have actually sunken to a 7-month low, dropping from 4.32% at the end of December to now 3.89%. But why is this? When the Federal Reserve determines whether to raise or lower interest rates, they must assess the health of the economy as a whole. Lowering interest rates is a method used for boosting economic activity during difficult times. As an example, the Great Recession of 2008. Conversely, when the Fed raises rates, it is seen as an indicator of confidence for the U.S. economy. However, the Fed funds rate is the interest rate set for banks to lend money to one another on overnight transactions and serves as a better gauge for the impact on loans or interest paid on CDs. Interestingly, mortgage rates are more influenced by the 10-year Treasury note, which the Fed actually has no control over. So while it's understandable for many of our colleagues to sit uneasy with this announcement, we must use the facts of our reality to direct our thinking and action. First, investors initially fell in love with the prospect of President Trump's prospective impact for the growth of the economy. As a result, Wall Street fled from bonds to stocks, and the market ballooned to all-time highs. However, the excitement of those same investors has softened, and anxiety due to uncertainty of much international conflict is leading them back to perceived safety. Safety found in bonds, in particular, U.S. Treasury bonds. The result of this shift is reflective in the declining yields for the 10-year Treasury note, and correspondent to that, the decline in mortgage rates. Second, home prices are rising because the demand for homes is outpacing the supply available to buy. If we could couple this with declining interest rates, we can only conclude that this change can only have a positive effect on the housing industry and our business as a byproduct. Let us not be fearful just because the consensus tells us to do so. Our success will be dictated by our ability to make sound decisions based on the facts, and the facts once again supports acting from a contrarian point of view. Let us remain focused. Thank you all for listening. I am always here to support you, so please connect with me on Facebook or LinkedIn at Matt Weaver Speaks. If you have a real estate topic for our next morning shot or blog, shoot me a message on Facebook. I love listener requests. If you're in South Florida and would like to meet for lunch, send me a message and I'll send you an invite to our next luncheon. Also, we have our Elevate conference coming up in October in Boynton Beach. So if you're looking for a great seminar on how to grow your real estate business by leveraging key mortgage concepts, send me a message on Matt Weaver Speaks at Facebook, and I'll secure you a seat today. I appreciate you joining me. Hopefully you can find a way to apply your shot into today. Until tomorrow, have a better day today than yesterday.